Hey, everybody. Thanks again for your patience and welcome once again to our weekly webinar. First one we've had a challenge on, and I can't remember how long, but thank you for bearing the patience to be with us. And again, this morning we have Charlene. You've heard her in the background with North American, and she's going to present to us this morning a way for us to go back out to our clients, especially our senior market clients, and discuss what we can do to help them obtain a legacy. Charlene, good morning.
Good morning. We'll just start right over right now, right?
Yes, please.
Thanks. Yes, please. Okay. So thank you so much, everybody, for bearing with us while we found a detour to share a presentation here. Mark's going to be changing the slides for me, and so if they don't quite match up, he'll catch up, just as soon as he follows my lead. So I'm going to be talking to you today about a newer product that North American has that's going to really help you offer another solution to your clients. And so, while life insurance might not be your primary business, it sounds like from my conversations with Mark that many of you do medical insurance or P&C. This is an easy product for you to position to those clients by just asking some simple questions. And so that's what I want to help you with today. And I do encourage you as we go through today's presentation that as you think of some of the clients that I'm talking about, write their names down, because we do want to give you the opportunity to ask us for an illustration, a simple illustration, just to see what it would look like for that potential client. So that you can start the conversation. And because of the technical difficulties, I might not be able to show you all of the tools that I intended to today, but I'll make sure that I share that in an email with Mark and Rebecca so that they can get it out to you afterwards. We have a great supporting website that goes along with this product that is easy to write down. It's a short website name. So if you'll write this down, NA for North American. So the website's going to be NALegacy.com. So write that down, and you want to check that out afterwards. But let's go ahead and get started. And I just want to remind you a little bit about who North American is. And we're going to start on the strong and stable slide just to introduce you to, so that you know the company that is backing the product that we're talking to you about today. So North American has A+ ratings from all of these that are listed here: AM Best, Standard & Poor's, and Fitch. We are the 5th largest writer of individual life insurance in the independent channel. We're part of Salmon's Financial Group, so along with our sister company, which is Midland National, together we are the 5th largest writer of individual life insurance. And we're the 10th largest writer of individual life insurance overall. The previous bullet was about the independent channel for agents. And then we as a company have private ownership. So what does that mean, and how does that make us different? Most other companies are either a stock company or a mutual company. So they either their policyholders are their owners, or the individuals that own stock in the company. We are privately owned, so each of us as employees of the company share in the ownership of the company. And so that makes us operate just a little bit differently. As far as when we design products, we design them with unique design features that are in the best interest of the client, and that are going to make our products sustainable for the long haul and be there when your client needs them most, which is at the time of death. So on this who do you know slide, these are the people that we're going to be targeting on this product. So these are the people that I want to just draw kind of a circle around and have you start thinking, and these will be some of the names that you're going to jot down for potential clients for this product. So these are our baby boomers. They're going to be people between the ages of 50 and 80. They're either approaching retirement or they're already in retirement. And because of that road to retirement, they either already have sufficient funds for their retirement, or they're in retirement and living fine off of those retirement funds. And then they might have like an emergency fund set aside. And you may or may not know about that unless you ask about it. And so one of the questions that we recommend that you ask your clients is, do they have any never money? And when you ask that question, because if you ask them a question like, do they have money that they want to pass on to their beneficiaries, they might not immediately think about that. So if you start with maybe the question about, do you have any never money? Their ears are probably going to perk up and they're going to say, what do you mean never money? Then you can go on to explain that never money is money that they have that they're mentally detached from already, and they truly intend on passing that on to their children and their grandchildren. But you need to find and know if any of that money exists, and you won't know unless you ask questions that make them remember that money that they might have tucked in a CD or a savings account. And so we're looking for sums of money anywhere between $25,000 and $200,000, and they're usually sitting in a low interest account like the CDs and the savings accounts. Heck, it might even be under their mattress or in their safe in their home. So somehow you got to find out if they have this money and what their intentions are for it. So on this opportunity page, just identifying that this product is for the baby boomers in that age range, and there are over the next several decades, these baby boomers, 75 million baby boomers, and you know some of them. In fact, you might be one of them. But they have nearly 30 trillion in assets that over the next several decades, as they pass on, that money is going to pass on to their children and grandchildren. So this is where the opportunity exists for you. And the first step is asking about it when you have your clients in front of you for whatever other primary reason that brings them to your office. So let's talk about what their concerns might be for the money that they have. They might consider that money that's in that savings account to be maybe a source of an emergency fund. And while they're in retirement, emergency can come in all different shapes and sizes. It seems like most of the time their concerns are about their own chronic illness at some point. So while that emergency might not be medically tied to a medical situation, it could be something that regarding their retirement lifestyle. So they want to. Those are their concerns for the funds, but if they don't need it for their own emergency or for their own chronic illness, they do hope to pass it on efficiently to their heirs. And so how efficient would be giving them the money that's sitting in the savings account, not as efficient as what we're going to talk about today. So we're going to talk about the solution that I have for you for the opportunity that's in front of you that you're going to start asking questions about. So let's, Mark, I'm on the slide now about the hypothetical asset allocation. There's a pie chart here.
Yep, right with you.
All right, excellent. So when what you already know about your client, or when you're asking them questions of their entire assets, the biggest bulk is going to be earmarked for retirement, and that is, and if they're in retirement, that will be considered their now money. That's what they're living on in their retirement. Then the two green sections here is going to be their discretionary funds, and we're looking for the piece of their later money that if there's actually a slice of that is actually considered never money. So they might have it all lumped together as discretionary funds, but again, you're asking the questions. Do you have any never money? Do you have any money that you plan to pass on to your children and grandchildren? This is the money we're looking for. We're not looking to try to take any money out of their retirement funds. No, that was put there for a reason. So what we're going to work through next is the objectives, the simple solution, and then the simple process for this product. So I'm on the slide now, objectives. And obviously, their objectives are simple. They hope that at the end of their lives, they're going to have a little money that they can leave to their family. But they don't want to give up access because they might need it, and they just don't know yet. So the challenges that they have as far as where they have that money sitting is it's usually in a low interest rate vehicle. A savings account doesn't pay hardly anything. Granted, if they have a sizable amount in there, then it might add up, but it's probably not going anywhere very fast. There's also taxes and inflation taking a toll on that money. And then risk aversion. That just means that they don't want to put it somewhere risky in order for it to grow more, because they also don't want it to lose any of its value. So they're not really interested in hearing a solution from you that could make the amount of that money go down. So this next slide has a bucket filling with water, and there's a couple extra add-ons here, Mark. So the first arrow shows like we have our bucket of money, and we're adding extra money to it little by little in the form of interest. And because of that savings account, it's probably pretty low interest rate. We're looking from less than 2% interest is going in, so not really making it overflow. Then we have a green arrow here that's portraying taxes. So when we earn interest on that money, now we have taxes taking a toll on it. We get a 1099 interest statement from the bank that says we earned how much, and now we have to pay some taxes on that. And then the last thing that happens to this bucket is it's got holes all over the bottom of it, and water is just falling through the holes, and that is inflation taking a toll on it. So even though we had this sum of money in this bucket, we have not very much adding to it, and more between taxes and inflation taking a toll on it. And so it's really losing its purchasing power over time. And depending on how long this money is sitting in there before the client passes away, it's not really growing that much. And so the product we're going to talk about today is we're going to be able to give them a whole lot more on day one and make it guaranteed. So this next slide, Mark, just go ahead and hit it. Looks like 4 times. We're going to have 3 images on there, and then a 10 years later at the bottom. So this is applying some actual figures to that bucket theory I just went through. Let's say that savings account had $100,000 in there. Maybe these baby boomers inherited some money from their own parents passing away, and a portion of it, say $100,000, they're going to just tuck away because that's what they're going to pass on to their 2 kids when they die. All right. So we have $100,000. It's sitting in a savings account. It's earning 1% interest. At the end of 1 year, we're at 101. Okay. Now there's 25% taxes. So now we're going to lose $250 in what we have to pay Uncle Sam. And then we have a rate of inflation that's over 3% taking a toll on it. So after 1 year, what $100,000 could purchase before, now it only has a purchasing power of $97.5. And if we fast forward another 10 years, that rate of inflation on there is taking a toll on it. And 10 years later, our $100,000 only has the purchasing power of about $77,000. So although it's not technically losing its principal value, it's losing its purchasing power. So now I want to introduce you to the solution. And the solution, we've got 4 boxes here. We've got, they should say, single premium wealth transfer, death benefit, cash value potential, and liquidity features. And so we're going to take these one piece at a time on the following slides. This is what makes up our product and making it ideal for a legacy building or legacy transfer vehicle. So the following slide, I'm on slide 18, death benefit. We've got 3 bullets to add here. So let's just go through each of them. With the death benefit, we can immediately leverage that, say, $100,000 into a much larger amount in the form of a guaranteed death benefit. And that can pass efficiently to their heirs upon their death. It passes to them income tax free, and it's outside of probate. And that wouldn't be the same case with money sitting in, say, a savings account. And then it has room to grow because again, they didn't want it to be anywhere too risky where it could lose, but because of a sizable funds, they were interested in seeing it grow, but they were giving up some growth potential to have access. So we're going to show you, or I have an illustration to share with you too that shows a pretty decent growth, and we don't even need that necessarily to make the sale, but if it grows based on index performance, that's just icing on the cake for the client. All right, let's move to the next slide, cash value growth potential. We'll have two bullets here. One is on the index credits and guaranteed premium bonus. So let me explain this. So when we dump this money in, say this $100,000, it's an indexed universal life product, but we have a guaranteed death benefit. So once the money drops in, if it earns interest or if it doesn't, if the index grows or it doesn't, that doesn't affect the guaranteed death benefit part of it. That would just affect the cash value growth inside. And so there's two choices. There's an S&P 500 with an annual point-to-point and an S&P 500 with spread. So there's just two choices. The illustration will give you some historical lookbacks on that. I think the maximum illustrated rate that we're currently illustrating is about just a little over 4%. So we're not selling it on a huge interest rate return. That's not what it's all about. It's more about the guarantee on the death benefit, but they do want to see that there's going to be some growth potential. Now, the product is built in with a premium bonus that kicks in or works from years 5 to 9. And what it does is it gives back 10% of whatever the single premium was that the client funded the policy with initially. So in this example I've been kind of talking about is $100,000. So 10% of $100,000 would be $10,000. So we're going to give $10,000 back to the client by splitting it up 2% for 5 years. So years 5, 6, 7, 8, and 9, and we're going to toss that back into their cash value over that 5-year period from year 5 to 9. And that's going to help their cash value grow too. And you'll see that on the illustration that we'll make available after today's presentation. So the next slide, as far as liquidity features, we've got 3 bullets here on this one. Remember, part of the concerns that the client has for that money that they had sitting in the savings account was, what if I need it first? I might need it first for my own emergency, that who knows what that might be, or for my own chronic illness. So what if I need it first? So they're not going to be interested in a product that they can't get to the money. Well, that's why we designed the product with liquidity and access. So first of all, right from after the first year, they can take 10% of their money, their account value out each year without any penalty. So if they had $100,000 in there and they need to take $10,000 out from years 2 and on, they can do that without any penalty. We make it a little bit even sweeter once we get to year 5. We say we're going to make it a return of premium product at this point. So if they stick with it, which they should, because unless of course those emergencies pop up sooner than expected, but the idea that they're going to leave it for their heirs, leaving this policy in force up to the 5 years should be no problem. So what happens in year 5 is that $100,000 they put in on day 1, now day 1 of year 5, that becomes their surrender value. So they put in $100,000. Well, now their surrender value beginning in year 5 is also going to be $100,000. So if they needed to get to all of it, they could. Now some of it would be subject to a surrender charge because a surrender charge is on the policy for the first 9 years. But if they needed to get to it, it would be accessible. And so if their emergency didn't occur until, say, year 10, then there's no more surrender charges, and it's completely accessible. There's also an accelerated death benefit. This comes included with the product, and that was one of their concerns. What if I become chronically ill? Great, you can accelerate the death benefit for your chronic illness. And when you have a death benefit that is more than what your your premium is that you put in, because we leverage that right away. And we're going to go through some examples here on these next slides. When we say you can accelerate 24% of your death benefit, now you're getting more than if you were just taking this out of your savings account. All right, so let's move on to slide 21, and we're going to kind of look at this sample case a little closer. Here's a pie chart of her assets. This is a 70-year-old female with an estate value of $475,000. The majority of those funds, 300, are her retirement funds, and then that 175 is her discretionary funds for later or for never. And it's your job to ask and find out. So slide 22, what we're looking at here is what could she potentially transfer to her beneficiaries 10 years from now. So if she's 70, we're looking at age 80 for her, which, maybe her life expectancy is longer, but we're just looking at, say, 10 years out. So if she left the money in those other vehicles, and in this column, 10 years later, what's guaranteed? Well, really just the 100 that she put in. It might be earning 1% interest. Of course, that taxable part doesn't necessarily come out of her savings account. That may come out of however she pays her taxes. But in a legacy optimizer, we can take $100,000 and turn it into $165,000 of a guaranteed death benefit. So whether she dies day 1 or year 10, we're going to pay her beneficiaries $165,000. If we have the green column added to this chart on this slide, if we fast forward out 10 years, and just not looking at the guaranteed, but what's the potential growth, that $100,000 in a savings account at 1 or 2% grows to 108, 122. That's still nowhere near what we can guarantee her on day 1 of 165. And if the cash value grows based on the index performance, her death benefit can actually be higher than what we guaranteed on day 1. And so in this example, in the green column here, it's showing $175,000 if she were to die at year 10. All right, so the next slide is going to be kind of similar, but now we're focusing on chronic illness because that's one of their concerns. What if they need the money before they die? And so one of their biggest concerns is chronic illness. So we should have a green column on this one too, and I might talk about them both simultaneously here. But again, the same numbers here, and we're looking out like she's getting chronically ill 7 years from now, so 77, 78, 79, and 80. If she were to just take money out of her savings account, her $100,000, she could basically split that for $25,000 each year. Based on how it's growing over those years, maybe then we're looking at a little bit more, 26 or 28. But focusing on the legacy optimizer, we can accelerate 24% of the 165, not the 100 she put in. So 24% of the 165 lets her have more. She can accelerate that until she gets to the residual amount. We have to still keep $10,000 of the death benefit payable upon death. But she can potentially get, a lot more out of that than she could out of either of the other vehicles. So do we have a solution that, kind of meets what her concerns are? Absolutely. So moving to the next slide, if we just look at her estate again, we found that piece of never money that she intended to pass to her heirs. And then when we turn that into a death benefit or a guaranteed death benefit of 165, we actually increased the value of her estate from 475 up to 540. So let's wrap this up with how simple the process is once you've found these clients, and hopefully you have a few names written down. In order to get a quote for this, all you have to do is let Mark and his team know the gender, their age, their state, that they're tobacco or non-tobacco, and how much money, anywhere from $25,000 to $200,000. So let's go to page 30. So you're identifying the prospects. Who did you know between those ages, 50 and 80, who have somewhere between $25,000 and $200,000? I would say that of the cases we've seen so far on this product, we're probably the average case size is around the $100,000 single premium. Okay, then you're going to confirm the goals. So this slide has, looks like about 4 bullets. So you're going to confirm the goals with the client. You know, are these funds something that you consider to be emergency funds that you might need to access for an emergency or even for chronic illness? How would you like to limit the impact that the taxes have on that money, you know, and not having it be a taxable event each year on the interest that you earn? And wouldn't you like to give your children and grandchildren more? You know, nobody knows when they're going to die and how long they're going to have to earn that interest. If you could guarantee them a certain payout today that they might not ever achieve by leaving it in a low interest rate vehicle, wouldn't that be some peace of mind? I think so. So here's how simple it is on this little next chart is there's no fluids, meaning there's no blood and there's no urine specimens to collect or a medical exam like you would think of in traditional underwriting for life insurance. This takes a different route. So we have a short application. Some of the tools that we make available for you has some pre-qualifying questions, some disqualifying impairments, medical situations that if they have that in their history, they wouldn't be eligible for. So I'll make sure that Mark has that process guide because that will help you see those pre-qualifying and those impairments that would disqualify them. So as long as you have cleared that kind of with your client, then you can do a short application where you'll complete the application and then you'll pick up the phone to an underwriter through a service that we've contracted with called ESP. And you'll identify yourself as the agent and then talk about your client, and then the client will talk with the underwriter and they'll drill down on some of those medical questions. So if you haven't pre-screened them, you know, you might get to a roadblock there. So do your part in pre-screening them on those questions that are in the guide. And then after maybe about a 15-minute call, you know, they'll need to tell them about their prescriptions and that kind of stuff as well. Then the underwriter will ask to speak back to you again, the agent, and they'll be able to tell you if the client has been approved or not. And so at that point, you can collect the check and send that in, and then we'll go ahead and issue the policy and send that out to you to deliver. So it could be that easy. Now we're to the question slide, Mark. I guess, and I know that we got a late start and we're kind of maybe making up some time, but I have a few more slides where I can maybe talk about, you know, the commission earning on that or looking for sales, but otherwise we can certainly end here. I guess I'll turn it back to you, Mark, for any comments or questions or where you want to go from here.
Great, Charlene, and yes, I think we did just fine with the process here today. We do have a couple of questions. I think some of them, as usual, have been answered during the course of the presentation, but let's just go ahead and touch on them as they are. First of all, Steve came in and wanted to know how the transfer of a non-Roth and a Roth and what they'll have to draw from. How does that help the product?
Well, they won't be able to move directly in here. They'd have to do the transfer of those first and then actually have them probably in a different vehicle like a savings account or a checking account to move them into this. So it wouldn't be a direct transfer. We do allow 1035s from another life policy to come into this, but those vehicles would probably have to be ended first, and then whatever's left at that point, if you know, they could put into this product.
Okay, good. And then, of course, the question came up about what type of underwriting might be involved. I think you pretty much reviewed that here quickly on the process and the basic application questions. The next question, again from Steve, is that his concern is that calling something a legacy optimizer doesn't tell what the vehicle is. There's no way his client will understand the value of the presentation. So he's concerned about, I guess, the client understanding the terminology.
Okay. So the name of the product is a Legacy Optimizer. It is a single premium index universal life product. And so, I mean, it is life insurance. And so when they're dropping that $100,000 in, it is guaranteeing, just like any other guarantee on a product, by prepaying it and dropping that in, it's guaranteeing that we'll pay, in this example, $165,000 upon death. But it isn't entirely locked up and not to be opened until death occurs. That's where we were talking about that they would have accessibility to those funds if those emergencies occurred or needs to access the cash, that they weren't totally locking it away and not to be opened until they died. I don't know. Does that help?
I think that does. Absolutely.
Okay.
And then we have a question about the product, which I think we all understand is that UL. And yes, Bruce, there is an application. Probably, again, the question was asked before we got to the slide. Nathaniel would like to know that as an agent himself, if he chooses to write this product on himself, will he receive a commission?
Absolutely.
There you go.
Absolutely. And that's a great place to start. And so I know that maybe not everybody on the call is in this age range, because it does have an age range 50 to 80. So it is a good place to start on yourself, or maybe it's on somebody in your immediate family, whether it's your parents or siblings, where you could see the benefit initially. And it just seems like it's the right thing to do when the client has already decided that that's what they want to do with the funds. You can just make it move to their beneficiaries so much more efficiently. We pay right directly to the beneficiary. It doesn't go through probate, and we're paying a whole lot more than those other vehicles. In this example, I use savings account or a CD. They're traditionally like the 2% or less. And so if we can lock that all in on day one, and the illustration that I have to share too will show that if the index actually performs well, they could actually get a higher return. And so in some of these examples, I think more around the life expectancy, maybe say 85, it had actually grown to maybe 180,000. And it could go higher. It could be, but it won't be lower than the 165. That's the key thing to remember, is you're locking that in. So Mark, I will send to you an illustration on this sample client that we talked about today, so they can see the full illustration. And then I'll also send it's called like the application process guide, and that will have those suitability questions and kind of the financial guidelines in there. Like, we can't take all of their assets and put it in there. So it'll kind of show you the percentage. And then those, the disqualifying impairments, those are all in there. So I would encourage everybody to get a copy of those from Mark, and then to utilize those. And then again, use our nalegacy.com website. There's a quote engine on there. So rather than having to get a full illustration before you talk with a client, you can go out there and it will have just a few inputs you'll have to put in, which is age, gender, tobacco or non-tobacco, and then how much money. So you put in the 100,000 and it'll spit out the 165 that we've been talking about today. And obviously it'll be different for whatever your scenario is. So then at least you can start the conversation right from that quote engine.
Okay. And then, because again, the presentation that the agents are following today, of course, is not for the consumer, Bruce would like to know, is there a presentation on this format that he could use?
Good question. On that nalegacy.com website that I've mentioned, while there's not a presentation, there is a short video that is consumer approved. And we found that those are usually more effective. A consumer is probably not going to want to sit through a 15 to 30-minute presentation, and they probably don't need that level of details. But there is a video out there, and I believe it's 2 minutes. Most of our consumer videos we find are most effective when they're in that 1 to 2 minute range. So there is a consumer video out there that can be used. Likewise, that video will link back to our YouTube channel where we have other videos that are consumer approved. And then also on that NALegacy.com website, there'll be a consumer guide. So there'll be more details in the consumer guide. That's also where that application process guide will be that I said that I'll share with Mark, but you can also grab it from there. So I would encourage you to get that website up, bookmark it. You don't need a username and password. You don't need to have a North American agent code to get in and use it. So bookmark that and get in there and see what other resources we have available to help you.
Excellent, Charlene. And that actually happened to be one of the next questions. If they needed to be appointed with North American to get access to it. And again, you've answered that wonderfully. But again, too, Mr. and Mrs. Sales Agent, obviously you do need to be appointed so you can write the product. So please go ahead and access that Messer website, go to our agent resources, go to our contracting tab, and get the paperwork started on your North American appointment. Thank you. Let's see, your 10% penalty-free withdrawal, is that based on the death benefit? So I guess what Bruce is alluding to is as that death benefit is increasing with time, does that 10% penalty-free withdrawal amount increase as well?
Actually, the 10% is of the account value. So when they put in their 100,000, those first 4 years, it could be less than 100,000, and then the ROP kicks in year 5, and then the account value will never be less than the initial premium they put in unless they've accessed some of it already. So it's 10% of whatever their account value is. But then yes, if their account value is growing and their 100,000 is turned into 130,000, then it's 10% of that. And it's during the surrender charge period, which I had mentioned earlier that the surrender charge period on this product is 9 years. But again, the surrender value beginning in year 5 will be what they put in, their initial lump sum. But it just again, it's a way for them to be able to access it if those emergencies pop up, because that was one of their concerns.
Okay, thank you. Mm-hmm. And then Biren would like to know if the product then has a higher cost or premium because it's a non-med product. So is everyone rated, I guess, standard?
Yeah, that's a good question. So thank you for that question. What basically are and in that guide that you're going to be able to access, there's a build chart in there, and the build chart for height and weight basically encompasses all the way to a table 4 up from our traditional underwriting. And yeah, so nobody's going to get preferred or table 2 on this product. You're just going to get, you're either approved tobacco or you're approved non-tobacco. And so in addition, yes, they could get more coverage, more guaranteed death benefit if they would have went through full underwriting. So with that, let me just give you an idea here because I had run these illustrations. So the same 70-year-old female we've been talking about today, if she truly can get standard and go through the underwriting process, she's going to get a guaranteed death benefit of $183 if she's standard on our Guarantee Builder product. So
Charlene, let me interrupt a second. Is that on one of these next 8 slides that are left?
No,
Okay.
I'm not in the presentation anymore. So I just hopped out to a different illustration now for myself to give you these numbers. So we do have another index product that offers a guarantee that you can do the same thing with. You can put 100,000 in, but it's going to take a longer process. You're going to do the application. You're going to do a paramed. We're going to get labs. We're probably going to ask for medical records. It could be 4 weeks, 6 weeks, depending before we have a decision. This one, you have a decision at the end of the phone call. But if you feel that that client is healthy enough and willing to go through that process, and you as the agent for a longer process, she could qualify for up to say at standard, she could get a higher amount guaranteed, and we're talking about 180. Now, the other example I want to say is if she was going to be like a table 2, the death benefit she'd get would be 158 on that product. So you can see the 165 is right in the middle there, and it was a whole lot easier and a quicker process. So we feel that this product is going to be ideal for the agents that do not primarily write life insurance, and it's more of a transactional type sale when those clients are already in front of you for the other services that you provide to them.
Okay. And I had a thought on that, but it just escaped me. Oh, yes. So based on those ratings, if someone did actually table rate at 4, you're going to shave them back to a 2?
You lost me there, Mark.
Okay, so even though they could qualify, you said, between table.
Well, the numbers I just gave you are for a different product if they went through full underwriting, if they're healthier or they're a table 2. So if they're a table 2, why not take the shorter path and not put them through all that, and you get more death benefit anyway? You get 165 versus 158.
Because their table 2 gets shaved to a standard.
Well, yeah, technically not shaved. We just only have 2 rate classes. You're either tobacco or non-tobacco. And our underwriting for that product basically spans all the way to a table 4. But nobody's going to get any of those. It's just going to be tobacco or non-tobacco.
Okay, excellent.
Okay.
And then, Burren, again, you have a question regarding commissions. You need to take that up to your upline or to call here at Messer to our agent services at extension 813 so we can look at your individual portfolio.
Yeah, and just basic, what I'd say on that is it's based on the premium. So rather than traditional life insurance has a target premium, there's 2 commission options on here that you can choose. And either you're going to get a percentage of the premium that they use to fund the policy, or you can choose an option that gives trails. And so that'll just depend on your own level of commission that you're at. But I just encourage you to take a look at it, use the tools and resources that I mentioned are on that nalegacy.com. Grab a few quotes, either from the quote engine on that site to get the numbers, or asking Messer Financial Group for those. And I can assist with that too, Mark, if necessary. But we'll make sure that you get a copy of the illustration that goes with today's example, and then that application process guide as well.
Excellent. And we have run the limit on the questions, and we do have a couple of minutes left, but I don't know that there's really enough time to hit these other slides you have.
Yeah, I think we'll just skip those because those are about the commissions, which you just advised them to call in. So I just encourage you to find some clients and start talking about it.
Okay, excellent. Well, again, ladies and gentlemen, I hope that you have received some information for the time you've given us this morning that's going to enhance your book of business. Again, recognizing the fact that if you've got those clients out there that you recently provided support to in either a Medicare Advantage product during the open enrollment, or if you already have Medicare supplement clients, those clients especially will probably have some of that never money available, that perhaps should create that first list that, again, Charlene brought to your attention. You need to start with somebody. And then if you want some samples run again, that's what we're here to do, to help you with that as well. Get an idea of where you want to go with that client. And again, too, we want to thank you and ask you that next week, if you'll mark it on your calendar again, on Wednesday morning, we'll have our Wednesday webinar session. And with that in mind, again, Charlene, I thank you for today's presentation.
Absolutely. Thanks for having me. I'm so sorry that we had the technical difficulties at the end, but between Mark and I, we found a workaround. Well, I don't know that we fixed it. We found a workaround.
Yeah, we did. So we'll take that up with GoToWebinar. And again, we'll look forward to having you with us again, because, ladies and gentlemen, you're probably aware, if you've been following the webinar series that Messer has been doing for a few years now, you're going to find us falling back to North American quite frequently. It's one of the reasons why they are one of the companies that I choose to do my own personal business with. They're not only easy to work with and easy to communicate with, but for agents, they provide a wealth of knowledge. Anytime that you're appointed with them, you are going to receive their emails to let you know about products and things that they're presenting. Even yesterday, Charlene sent me a very interesting email. Maybe we could just touch on that for just a moment, since we got about a minute left here. And that had, Charlene, do you recall
Yeah.
that
Yeah.
reading?
Well, basically, we have advanced underwriting consultants on retainer for North American and our agents and our agencies that are contracted with us. And so he's advanced underwriting and taxes when it comes to life insurance. And so he's on retainer. So he's free of charge for a phone call. Now, to utilize him, you would have to be contracted, because one of the questions he's going to ask is your agent number. But if you're pursuing a policy for North American, then you just might need to utilize Mark's help, on a conference call that way, or an email maybe that he can forward to them or whatever, and they'll get back. But basically, they provide us with a monthly newsletter, also monthly webinars, and then they're just always on standby for any of those questions that we have, and we can send them to them by email or phone calls, and they're very timely and thorough, very thorough on their response. So the primary contact we have there, his name is Linus Stugis, and he has just been a great resource for North American. I mean, I think it's been 10 to 15 years that we've had him contracted. So he's definitely somebody great to have in your corner and get the additional advice that you need on designing a more complex type of case when it comes into ownership and taxation, and and would this set up work or not work, and he can just give the insight on that. So he doesn't necessarily, it's not about underwriting for North American, it's more of the design and the tax situations, and would this create a taxable event that he can assist with.
And that's going to become very important to you to know that you have that type of a resource, because again, when you're dealing with any of the retirees that we're talking about, or pre-retirees, and you start talking about 6 figures of legacy being consumed, these are people that have a definite financial wherewithal about them and have sought professional help and guidance. So you don't have to be nervous, because you don't have to be thinking, what if I need to get a hold of an attorney? What if I need some legal advice? Here you've got it, ladies and gentlemen. So what more could you ask for? Okay, we're at that 10 o'clock mark. And once again, Charlene, thanks for hanging in there and making this happen today. The rest of you, please also have a great week, and we look forward to having you with us again next week. Thank you very much. Bye for now.
Thanks, everyone. Bye.